Up until this point, we've mainly explored liquidity risk management from a consolidated, group-level perspective. We've discussed buffers, funding markets, contingency plans, and regulatory ratios, with the implicit assumption that the bank is a single entity managing liquidity as one integrated pool. But in reality, most large banks operate across multiple jurisdictions, legal entities, currencies, and regulatory regimes. Now, this creates a whole new set of challenges. In this session, we're going to focus on cross-border liquidity management, how banks handle liquidity fragmentation, regulatory ring-fencing, currency mismatches, and operational coordination across geographies. We'll explore how group-level oversight can be maintained without breaching local requirements, and how firms manage liquidity effectively across a globally distributed footprint. By the end of this session, you'll have a clear picture of why cross-border liquidity is both essential and complex, and how institutions can strike the right balance between centralization and local resilience. So let's begin by understanding the core issue. Liquidity is not always fungible. Now, while capital can often be allocated or moved freely across a banking group, liquidity is subject to a range of constraints. Now, these may include regulatory restrictions, legal entity boundaries, currency controls, local funding practices, tax implications, and operational infrastructure limitations. Now, the result is what we call liquidity fragmentation, the phenomenon where liquidity becomes trapped or siloed in parts of the group, reducing the effectiveness of the overall buffer. One of the biggest contributors to this fragmentation is regulatory ring-fencing. After the global financial crisis, regulators in many jurisdictions introduced rules to ensure that local banking entities could survive stress independently of their parent groups. Now, the idea was to protect domestic financial systems from contagion caused by foreign bank failures. Now, these measures include requirements to maintain local liquidity buffers, limits on intragroup flows, and restrictions on upstreaming cash or collateral to the parent company. For example, a UK subsidiary of a global bank must comply with the PRA's liquidity rules, including maintaining its own LCR, demonstrating standalone resilience under stress, and submitting detailed reports via the PRA 110 template. It cannot assume unrestricted support from its parent, and any intragroup funding agreements must be operationally and legally robust. The same is true in the EU under the single supervisory mechanism, where subsidiaries must comply with local regulatory expectations set by the ECB or national authorities. In the US, the Federal Reserve requires large foreign banking organizations to establish intermediate holding companies, or IHCs for short, and hold sufficient liquidity at the local level. Similar requirements exist in Australia, Canada, Singapore, and elsewhere. Now, each jurisdiction wants to ensure that local customers, markets, and obligations can be serviced regardless of what's happening at the group level. Now, this has profound implications for how banks manage liquidity globally. Group-level buffers may not be deployable in practice. A parent company may have excess liquidity, but its subsidiary in another country may not be able to access it due to local restrictions. Now, this leads to the need for entity-level liquidity management, where each material legal entity maintains its own liquidity position, its own buffer, governance, and contingency plans. Now, Treasury functions must therefore operate in a dual structure: centralized oversight with decentralized execution. Group Treasury sets global policy, monitors consolidated risk, and allocates resources. Local Treasury teams manage day-to-day liquidity within the parameters of their jurisdiction. Now, this includes monitoring local LCR and NSFR, executing funding in local markets, engaging with local regulators, and preparing for local stress scenarios. Now, communication and coordination between group and entity-level teams is essential. This is often achieved through regional Treasury hubs, liquidity councils, and cross-entity reporting structures. Group Treasury may require daily or weekly updates from local entities on liquidity positions, funding plans, and risk metrics. Local teams in turn rely on the group for strategic funding, pricing curves, and access to shared tools or models. Now, one key challenge in this structure is the management of intra-group funding flows. These are the internal loans, deposits, or repo transactions between legal entities of the same group. Intragroup funding is a critical tool for allocating liquidity across the organisation, but it must be carefully managed to comply with legal, regulatory, and operational requirements. Now, banks typically use intragroup funding agreements, which are legal contracts defining the terms, the pricing, and limits of liquidity flows between entities. Now, these agreements must be enforceable under stress and tested regularly. Now, regulatory scrutiny of intragroup arrangements has increased significantly, with authorities asking banks to demonstrate that such flows can be executed in a timely, transparent, and legally binding way. If not, regulators may disallow the inclusion of these flows in the LCR or NSFR calculations, reducing their effectiveness. Now, intragroup flows also create counterparty exposures, which must be monitored for credit and capital implications. The transfer pricing mechanisms must reflect appropriate risk premiums, and collateral arrangements may be required in some cases. Now, some regulators place hard limits on the size of intragroup exposures, particularly between systemic entities or across borders. Currency risk adds another layer of complexity. Now, banks operating in multiple currencies must manage liquidity in each major currency, not just in aggregate. Funding raised in one currency cannot always be used to meet obligations in another. Foreign exchange markets may be disrupted during a crisis and convertibility can become constrained. And because of this, regulators often require banks to monitor currency-specific LCRs, stress test FX liquidity, and ensure access to central bank swap lines or local FX markets. To manage this, Treasury teams use a mix of foreign exchange swaps, cross-currency repos, and multi-currency bond issuance. FX swaps allow banks to temporarily convert one currency into another, typically exchanging notional amounts and reversing them later. Cross-currency repos involve pledging collateral in one currency in exchange for cash in another. Now, these instruments are useful, but they require available counterparties, functioning markets, and appropriate collateral. Now, during stress, their reliability may decline. Banks also maintain currency-specific liquidity buffers, ensuring that each major currency has enough high-quality liquid assets to meet projected outflows. This often means holding sovereign bonds, reserves, or central bank eligible assets in local jurisdictions. Now, these buffers must be ring-fenced, tracked, and reported separately, adding operational and analytical complexity. Now, cross-border liquidity management also involves recovery and resolution planning. Regulators require banks to demonstrate how they would respond to severe stress scenarios, including the failure of one or more legal entities. Recovery plans must show how liquidity would be preserved or reallocated within the group. So resolution plans must demonstrate that critical functions can continue without disrupting local financial stability. Liquidity plays a central role in these plans, especially for systemically important institutions. One approach used by many banks is the self-sufficiency with support model. Now, this means each legal entity is expected to be resilient on a standalone basis, but can receive support from the group when needed, under predefined conditions. Now, this balances regulatory expectations with group-level efficiency. In practice, this model requires careful calibration of buffers, legal agreements, and operational readiness. Another emerging approach is the pre-positioning of collateral and liquidity. This means ensuring that assets are already located in the right place, in the right currency, and with the right legal access before stress hits. Banks increasingly invest in systems that allow them to track and optimize collateral location, eligibility, and usage across the group. This supports faster execution of contingency actions and reduces reliance on post-crisis transfers. Cross-border liquidity also has a technology and data dimension. To manage liquidity globally, banks need integrated systems that can capture positions, flows, and risks across currencies, entities, and products. They need real-time dashboards, automated reporting, and scenario analysis tools that allow group and entity teams to share insights, respond to changes, and coordinate actions. Manual processes or fragmented systems create delays and reduce visibility, especially during fast-moving stress events. And governance is equally important. Global banks typically establish liquidity management committees at both group and regional levels, with clear terms of reference, reporting lines, and escalation procedures. These committees monitor key metrics, review funding plans, oversee intergroup flows, and manage stress scenarios. They also serve as the interface with supervisors, ensuring that the bank can explain and justify its approach across jurisdictions. To support this, firms maintain cross-border liquidity policies that define the principles for allocation, monitoring, and contingency planning. These policies are reviewed by the board, shared with regulators, and embedded in internal training. They ensure consistency while allowing for local flexibility. To summarize, cross-border liquidity management is a complex but essential discipline. It requires balancing central control with local autonomy, integrating data and systems, managing multiple currencies and counterparties, and navigating a patchwork of regulatory expectations. When it's done well, it allows global banks to operate efficiently, respond quickly to stress, and maintain trust with regulators and markets across the world. In our next session, we'll shift focus from structure to strategy, looking at liquidity planning and forecasting. We'll examine how banks anticipate liquidity needs over different time horizons, how they integrate business strategy with funding needs, and how they build robust forecasts in an uncertain world. We'll explore how forward-looking planning turns liquidity risk from a reactive challenge into a proactive opportunity. I'll see you in the next session.